There's essentially two types of trading strategy. You're either looking to go with the trend, or you're looking for a contrarian trade to go against the trend. After that, it then breaks down to the four types I'm going to be looking at, break down into either a passive or a more aggressive style of entry and aggressive way of taking the trade on. So first up, let's have a look at a breakout trade. This is a trend-based trade. The idea of a breakout trade is you're essentially trying to get on the beginning of the trend. So it's going to require an aggressive entry at market on the break of a level. That's the key thing that you need to be looking for. Now, what it requires is a very good understanding of flow, of volume coming into the market. This is going to tell you whether the break is on, whether the break is going to be sustained as well. The difficulty with this trade is that markets actually break a lot less often than they range. So there is a big onus on win percentage here, either via learning how to take the trade on at the optimal chance of it working, or by cutting your losses quite quickly and understanding when it's not working, and then when it does, holding on to the trade and going for the whole trend rather than just trying to play the quick break for that initiative quick move. So that's your breakout type strategy. Very aggressive at market, very focused on flow and volume. Your more passive version of a trend following strategy is a continuation type trade. This is where you wait for a pullback, you wait for the market to come back to a level after it's clearly shown you that there is a trend on, so it's the second wave of the move you're looking for. It is a lot more technical based and does require a bit of patience in planning where the pullback should be coming to. You can have quite a defined stop. You can also then, as you get that second break, assess whether the trade is going to be a good one to hold on to or not, looking at your breakout type strategy. But what it's going to do is it's going to mean that you are generally onside before that break, meaning that if it doesn't go your way, you're actually still going to be getting out for a profit by taking this more passive entry. The risk with this type of trade is that on a very strong move, you're going to get left behind, you won't get those pullbacks, and so you're then stuck seeing a very, very large move and not actually being able to get onto it or make anything out of it. So secondly, after that, this is then your more contrarian reversal type trade, and we will look at reversal straight away. This is the more aggressive entry. This is where you're trying to pick a turning point in the market and go against what is currently happening. Particularly on a trend day, this is where you would be using this type of trade, or where you see the beginnings of a trend and then that trend start to fail. So there is a bit of focus on technicals as well as flow. You need to see some kind of chart pattern that tells you that there is a reversal on. Big thing with this, it does require a lot of confidence to go against the crowd. You could be sitting in an office like this and you can hear the whole office encouraging the trades on. They think the market's going higher and you've got to pick the point where it's going to turn. That can be very unnerving, and what is often difficult with a reversal trade is that as soon as you start going on side, you're very inclined to get out of it because of the fact you feel like you've got away with it. So you've got to be very confident in the trade to take on the reversal type trades. Also, something, and this is one of the big downfalls of a reversal trade, use it for the right reason. Very often, if you're playing a more continuation style trade and you miss out, you can often fall into the trap of taking on reversal trades because you're not managed to get long if the moves are up. And so you're then thinking, right, well, it's got to stop at this level, it's got to stop at the next one. So make sure you're using it for the right reasons. And this is where building a clear strategy will help with that. And finally, you've got range band trade. This is when you've got a much slower type market. Think of the balanced days when we were talking about market profile. That's where you want to implement these type of trades. Key is it is going to be passive. You are going to be looking at technical elements of the market more than flow, because there will be a lot less flow on these type of days. And so it's essentially about getting in, being patient and waiting for your trade to rotate back to where you expect it to move to. Key to this type of trading is identification. Identify where that range is going to build quickly, because the later you leave it, once a range has started to build, positions have accumulated. If it starts to move outside the range, then they're going to shift those positions and all of a sudden the range breaks. So fast identification is very key with range bound trading. So let's move on. We'll go and have a look at how to build some strategies. This is where your money is going to be made. As I said very early on in the course, everything in trading is all about process. If you can get the process right, everything becomes a lot easier, and it's no different with creating a strategy. So this is the process that I use. Keep this in mind as we go through it, and every time you're developing a new strategy, keep this process in mind. Have an idea for the trade, test it, find out if your idea is actually right, or are you just seeing something because you've seen a trade work well for you. So test the idea up, see how valid it is, then define that trade. Nail it right down to exact criteria of what exactly you need to see for this trade to be viable. Execute it. Know exactly what you're going to do, where your stops are, where your targets are, and then start executing it. Once you're doing the trade, you'll then start finding out if there are little nuances to it that perhaps you hadn't noticed from the charts. Perhaps these were things that you were seeing or wanted to see. So this is where the execution is always going to help. And this again is that deliberate practice of the trades that you've come up with. Evaluate your trades. Always evaluate your trades afterwards. It's going to give you areas to improve the trade. It's going to start telling you if it's not working before it starts becoming detrimental to your trading. Any trade that isn't working is an opportunity cost. So the quicker you can evaluate that and stop using the trade or step back from it, the better you're going to be. So keep this cycle in mind as we go on, and let's start moving on with ideas. You can't produce a trade without an idea, and these ideas can come from all sorts of different places. So we're going to have a look at a few key places to be having a look at, but anything that you think of, anything that comes to mind, can all become an idea, and then it's just down to testing whether it is a valid one. Look at reactions in the market. If you start seeing something consistently happen, it's not about what happens, you've got to ask yourself, what happened before it? Are there any defining characteristics to this trade? Is there something that goes on that can tell me that this is on and is going to give you a way of getting into the trade? So it's more a question of what happens next, or what happened before this, rather than, oh, I've seen something. So that's the way you want to be looking at it. Always question what happened before, or why did this happen. Keep notes on everything. Any new things that you've seen coming into the market, any new patterns, anything like that. Keep some notes on it. This way you're going to start recognizing them a lot quicker. Again, it's deliberate practice for you, but it's going to get you thinking about things more often. I keep a note every day. I just write down little things on my bit of paper in front of me, anything new that I'm thinking of, and these eventually may well build into trades. You might see that it happens once and you've not noted it down again for months. Clearly that was just a one-off. Speak with other people. It's really important. Get their ideas. Just because they've developed an idea doesn't mean that it's going to suit you, but you can take elements from it. You know, they might say, oh yeah, have you seen the way the market reacts to these numbers, the way it does this, that and the other? That's going to give you a little bit of an idea. And again, it's then a case of what happens before that. Can you actually find a reason to be in a trade before the move? Look at Twitter as well. I know Twitter can be a little bit of a dangerous thing, in people will often try and promote certain things, but anyone who is giving out an actual trade, take it away and actually assess whether it is a trade that you think is valid, and whether you can actually start implementing something similar or improve on it in any way. Events, we've already spoken about this as well in the fundamental things. Do certain figures have particular nuances? This is going to give you a way of developing a strategy around them. As I said, I have the idea of the first minute candle on the Bund and the S&P on non-farm payrolls. This is a strategy that I've developed just from noticing these little things and trying to work out, is there something consistent in a figure? Again, this is going to work for an event type trade as well, in understanding if something happens, what the market's likely to do. And finally, have a look at textbook trades. There's a lot of textbooks that will tell you, if you see this, this will happen. Go and question those, because I do know that some of these trades have been proven not to work. I'll give you a good example, which for quite a while was not working very well is an open drive type trade in the bunds, that if you opened and then drove down or up, and so the opening price was the high or low of the day, it was actually, rather than that turning into a trend day, which would be the expectation of an open drive trade, what was happening is actually that would indicate that the market is highly likely to go back and take out that high or low. So a textbook trade there was in fact doing the complete opposite, and you had a much greater chance of making some money by actually going against that idea. Do remember, in any of these things, it's your trade. If you are not the one who's developed it, you're not going to have the confidence when it comes to actually putting the trade on, because you're never going to know what someone else would do. If you take someone else's trade and you think, right, they would get in here, you don't know where their stop is, you don't know how they're going to manage their trade, so make it your own. As long as you've got it yours, you know what it takes to make that trade, then you're going to have confidence in it every time, and the only person you're accountable for then is to yourself. You're not able to blame someone else, so it's a case that you're going to own that trade. That's the key thing, own your trades. Key thing when testing trades is to remain objective. Don't put a trade on, see a good win out of it, and then assume this is a foolproof strategy. It's a bit of that gambler's fallacy. We've all got a mate who's been down the pub, won 100 quid on the fruit machine and tells you all about it. Doesn't then tell you about the 50 times he put a fiver in before that. So just remain objective. To do this, when you run it through the charts, I always start, say, 6 months ago and run forward. This way you always see the pattern before the result, rather than going back through your chart, seeing what you want to see and then noticing that the pattern is there. So work it that way. That way you test every time. It's also great pattern recognition as well, so there's that deliberate practice for you. So even if you don't find a trade, you still gain something from it. You've gained the ability to recognize certain patterns. It also may give you a trade the other way if you prove that a certain thing doesn't work. Now, what you want to be looking at, and this is where you need to be precise, what happens before the trade? What happens before that pattern emerges? Or what do you see in that pattern before the trade emerges? Is it a volume thing? Is it a distance away from a certain area? That kind of ATR trade that we talked about in the technical day? Or is it even a time-based thing? Things like going into cash closes, into settlements, that can be a very time-based element, that you know that at a certain time of day, you want to be looking out for a certain type of flow or a certain type of trade. Next up, you've got to assess what triggers the entry. What's going to get you to put the trade on? Do you need to see a break of a level? Do you need to see a candle close beyond a trend line? Do you need to see a certain amount of volume trade through the market? That's what's going to tell you where your entry is and allow you to put that trade on. Is it the way the market approaches an area? If you start seeing this is a great reversal type idea. If you see the market very quickly flush down through a level, often that's a desperation panic move. That gives you the opportunity for a reversal type trade. Very ladder based, that idea. Next up, you've then got to decide if it's viable. There's no point in focusing on event trades and scenario building if you're a purely systematic type trader. So make sure that the trade is viable for your style of trading. You know, are the stops too prohibitive? It's nice spotting a great swing type pattern or a great reversal pattern, but if you've got a huge stop that doesn't fit in with the rest of your type of trading, then even though the trade may well work, it doesn't suit the way you're going to be trading and can then end up skewing the rest of your trading for the day. And also, slightly more advanced as you get into it, look for multiple entries on a trade. Does it give you places to pyramid? Does it also give you a place that you could get in, but if you don't get that entry, is there somewhere else? I use this particularly on a Bund inside daybreak type trade. I have a passive entry before the day breaks at the VPOC. If this doesn't work or I don't get filled, I've still got the actual breakout trade on the inside day as you break out of the high or the low of the day. So see if you can put some options into your trades as well. Okay, so testing back on a Bund trade, this is a VWAP trade, so you're looking for the the bund to revert back to the VWAP and then offer you a secondary move, continuation type trade. So what we've got here is a few examples where the bund has come back to the VWAP. You're then looking for what criteria is there that tells you that this trade could well be on. Similarities between all of them that lead to a new move and a new target. So each of the trades here, what you've got is on the test back to the VWAP, you get a move to a new high or a new low. So that's giving you an idea of what your target should be. The distance that it goes past the high or low is unclear. You see that some of them, on this third example, only just break it, whereas later on, you get, or earlier on, you get quite large breaks. And so that becomes difficult. What you've then got to do is start factoring in, is it worth trying to hold the trade, or do you just run the trade as a trade to a new high, get out? That's a very clear target. If it's still offering you a decent risk reward, then it's still a good trade. So what else have we got to be looking at? Another common thing is you're getting an impulsive move away from the VWAP. You see it here on the downside, and here very much on the downside. So you're getting an impulsive move there that takes the market away from the VWAP, and you get a very clear move back to it. The impulsive move does need to see a bit of volume increase, which you do get, very much so on that last one. A little bit less on this one, but again, impulsive move, volume increases before you get the move back. What also you may not have noticed is these highs, or the high on this candle, the low of this move, are all done on, at the time, and this is the point, at the time, the highest volume 15-minute candle of the day. Apart from this last trade. However, this was quite exceptional volume on that first move down, nearly 4,000. So slight differences there. The high volume 15-minute candle, you can either look at it as the high volume on the day or the high volume on the move. I prefer to look at it on the day. I feel it adds a little bit more validity to the trade. And I'll talk to you a little bit later about trade quality and risk management there. So that's another element of the criteria that you want to be seeing. Now, the next thing you've got to start asking yourself is, if you get in this trade, where are you going to stop out? How far through has it got to go before you're wrong? We've got an example quite nice here of it moving through the VWAP. Now, what you can work out is that actually, if you have a 5-tick stop, that prevents these little spikes from catching you out just through it there. Little spike just through it here as well, and also slightly larger spikes. None of them go more than 5 ticks through. So there you've got an idea that if you give yourself 5-tick stop, you should be pretty safe. Alternatively, you can use a close through the VWAP, which would also give you a stop. What it does mean is that it could go quite a long way through and you're still waiting to see if the close is there. So I like to have either a close or a number of ticks. So what we've got here essentially is you need a move away from the VWAP. Also, you're noticing that this move away needs to be at least 20 ticks. If it gets over 20 ticks, then it makes that move back to the VWAP that little bit larger, and therefore the market has got to move that bit further. It can run out of energy, and what you also see on the moves back is this running out of energy. As the energy starts to run out, you can see it there. As we come back and the energy runs out, and again, as we come back, the energy runs out, and again. So as the energy starts running out of the market, that's telling you again that that VWAP is likely to hold and offer you the trade. So you want to be looking for 20 ticks, you want to be looking for the volume to start dropping, the energy to move out of the market. And all these little factors allow you to define the trade and be able to spot it that little bit more readily when it comes round to it. You know, the pattern doesn't always look exactly the same, but the principle of the number of ticks away that it moves, the way it does that move, the impulsive nature of the move, the higher volume and then the lower volume on the pullback, allows you to define the trade, allows you to get on the trade, and we've also established quite a clear target from this as well. So that's your Bund VWAP testing. It's now just a case of actually defining it very clearly and also defining your execution. So from those examples, we can create a definition of the trade. These are the precise characteristics that you want to see before you're going to enter the trade. So let's get them down. First up, you need to see the impulsive move away from the VWAP, increase of volume and an impulse away, up or down. This move does need to then get 20 ticks away from the VWAP. It also needs to create a new high or low on the day. Very important to see that. So also when you're starting to think all this trade could be on, make sure that it is 20 ticks away from that VWAP. The high or low candle needs to be the highest volume 15-minute candle of the day. And you also then need to see a falling volume on the pullback. This is going to show you that the market hasn't completely turned and is not likely to just push straight the way through. So see that falling volume. If you've got all these areas ticked off, you can then start thinking to yourself, right, the trade is on, time to think about execution. So remember to keep that definition very precise, know exactly what you're looking for, and this takes away any doubt in your mind. What it also does is it gives you something to test in other markets. Does this trade work somewhere else? Parameters might need to be adjusted if the other market that you're looking at has bigger or smaller ranges, but is that trade a viable trade in other markets as well? So something to test there. Execution. This is a continuation type trade, so it is going to be based around passive execution. The key with execution though is knowing exactly what you're going to be doing. It takes all doubt. Remember earlier on we were talking about how once you feel that the trade is about to get executed, you get this build up of adrenaline, it can cloud your judgment. This takes away all doubt. You've ticked off the boxes, you know what you're going to do, and so then it's just about executing according to the rules that again you set for yourself. Make the execution a process. So first up, your entry. Where you're going to enter, how you're going to enter. In this case, we're looking for a resting order at the VWAP. What I do is I split the order across the VWAP. So what this does is it means that you will get filled if it gets towards there, or it aids that fill. If it just touches the VWAP, it could end up that you don't actually get filled. So having an order just in front of the VWAP, on the VWAP, and just behind means that even if it goes slightly through, you're essentially in the same position as if you got your whole fill at the VWAP. But also by having that order ahead of it means that you can get in even if it doesn't quite touch it or doesn't quite fill the order that's resting on the VWAP. So that's the type of order you're going to be using to enter. Your stop, I've used a 5-tick stop. So if it moves 5 ticks through the VWAP, there's your stop, you get out of the trade. Alternatively, you can have a close past the VWAP. So it could be one or the other. It could be that it's 5 ticks or the close. So that's something that you can play with, and that's where the improvement can come into it. But my way of doing it is generally just 5 ticks through it. And your exit. How are you going to get out of this trade? In this case, you're looking for a new high or a new low. So you have a very clear target. So you can put a resting order in for that new high or new low. Again, you can spread the order slightly ahead of it and slightly behind it. So you might have an order on the low, if we're going down, on the low, a tick below, which is the new low, and then a tick below that in case it pushes. So that's what you can be looking for. That's how you're going to execute your trade. As long as you've got that very clear in your mind exactly what you're going to do, makes the trade easy to do, and you can do it with a lot more confidence. All right, an evaluation based on statistics. I like to keep a track record of charts. These are purely illustrative numbers. I don't want this to come across as advice on a trade that is definitely going to work. So I have just used illustrative figures here. Now, what you can do is keep a track record of the win-loss rate of your trade. Important thing to remember here is a win-loss rate doesn't necessarily have to be above 50 for the trade to be worth doing. If the risk-reward on the trade is very, very good, then your win-loss rate doesn't have to be above 50, because when you do win, it cancels out the losses. So if you've got, say, a 25% win rate, but whenever you win, you get a 10-to-1 risk reward, 3 times out of every 4, you're going to lose 1. 1 time out of every 4, you're going to make 10. So actually, you're still doing quite well on the trade as an overall risk reward. So note down how many ticks you're getting when the trade works, how many you're losing when it goes offside. First thing that you're thinking here is, why have we got a 9-tick loss on what should be a 5-tick stop? This is either down to you adjusting your stop and pushing it further out to try and not get caught on it, or it could be a factor of slippage. So again, that's somewhere where you've got to come back and analyze why was the reason for the anomalous 9-tick loser. But nonetheless, taking into account the possible win and the stop, this is going to give you an expected risk reward. So you've got nearly 4-to-1 risk reward on the trade. So pretty good risk reward relationship there. Also, keep a track of what you're getting filled, because this is what I was talking about with positioning your orders across the VWAP. Sometimes you won't get filled the full amount. You can see here, you get 2, you get 1. So you're not getting the full fill. When you lose, of course, you will always get the full fill because it's got to go through you. So this is something as well that you've got to start thinking about. From that, you can then rack up your actual profit in ticks and your actual loss in ticks, giving you an average profit, an average loss, and an actual risk reward. Notice how this is quite a bit lower. This is due to execution risk, but it could also be flagging up certain things that you're doing right or you're doing wrong. You know, if your actual risk reward is dropping significantly lower than you're expected, something going wrong in the trade is perhaps indicating that you clearly could be taking a certain amount out of the trade and you're not. So this is where you've got to start addressing, is it the way you're getting filled? Is it the fact that you're taking the trade off too early? What is it that's changing that's not giving you the risk reward that you expect to be getting? So I then also take it onto a profit per lot. This way you're actually looking at how many ticks you're actually taking out compared to the number of ticks you could. So what we've got then is a percentage profit. So it's a percentage of your potential. Now, what we can see quite clearly is we have got one very, very low score down here at 38. Why is this? Run it back, have a look at what's gone on. Got a reasonable tick win, 26, seems around about the average that what we've been seeing. The difference is you've been filled 5 lots. Perhaps this is an attempt to up the size, but you've only taken a profit of 50. The expectation, if you put 5 lots on a 26 tick win, your expected profit should be 130. So you're actually seeing a much greater dip in your profit percentage. So what this is actually indicating is you're taking a much bigger risk, because if you get those 5 lots offside and get stopped out for 5, 6 ticks, that's 25, 30 ticks loss. So this is clearly showing you that either your confidence in trading extra size is lacking, or you need to find a way to get around that. Perhaps it's a case that you just put the trade on, put your stop in and ignore it. Wait for it to do the move. Doesn't matter whether you've got 3 lots, 5 lots, 25 lots on the trade. If the trade's going to do what you expect and does, it will do it, no matter what size you've got on the trade. Of course, once you start trading bigger than an average bid or offer in the market, then it does start to influence your ratios. But if you can trade that amount at market, then it shouldn't affect you. In this example, in the Bund, a 5 lot's not a problem. You could trade a 50 lot and it wouldn't make a difference. So there's clearly something going on there. Obviously, you're also seeing the opposite. When you trade a 1 lot, so when you don't get filled as much, is it a case that you stop caring? So you decide, right, I'm just going to run this right the way, get the full amount out of the trade. if that's the case, then you can clearly use that attitude. You can clearly do the trade when it's a one lot. So you've proven to yourself you've got the ability. You can then move it on and start taking bigger and bigger trades out of it. And that's the key thing that you can take away from this kind of analysis, that what difference is in the size that you're doing compared to how far you're taking trades. And just trying to make your trading a little bit more efficient. By going through this, you can start flagging it up and notice those little nuances in terms of size. And also ask yourself questions about, why was it that 2 trades apart, you've managed to take the full trade, and the next one you've only taken just under 60% of it? What changed on those 2 days? Analyse, were you up on the first day and so you're willing to hold it? Were you down on the next? Or the opposite, were you down and you decided, I've got to hold it, go for the Hollywood trade? So all of these things, try and figure out why it is that your percentages changed on any day, and also consider a lot about that profit per lot. That's what you need to make count. Get each lot to pay you as much as it can. The statistics are going to tell you a lot about the performance of a trade and where perhaps it's lacking in performance, but it's the personal evaluation that's going to actually flag up why it's lacking in that performance. That's the key thing. Now, go through every part of the trade, each step individually, how you felt there, are there any characteristics in the way you trade it? Are there any also characteristics in the market? You're looking for improvements here ultimately. You're not looking at reasons to doubt yourself on the trade. You're looking at ways that you can improve it. So first up, look at your entry. Did it go according to plan? Did you enter where you intended on entering? Was it a case that you got in too early because you felt you were going to miss it? If that is the case, why are you getting in too early? Is it a lack of confidence, or is it just a desire to get in? If it is just a desire to get in early and you're finding that this does mean you're always in the trade, that's fine, as long as the larger stop is still acceptable as a risk-reward basis. So it's not always a bad thing to be getting in early. What it does mean is that you're guaranteeing yourself an entry. And if there are characteristics in the market that can tell you to get in early, then again, more useful. So that way you can start developing the trade and adjusting the entry criteria so that you can guarantee yourself a full fill. If you're missing the trade, or if you're hesitating on the entry, this is where you've got to start looking at what's making you do that, what's making you hesitate on the trade. If you can pick up those characteristics, perhaps it's a feeling as the market comes towards you that, oh no, you don't think this is going to work, then perhaps it's a case that you can step away and then just put the order in, put the stop in, and wait for it to get filled, and just accept that in a way you've lost that money. If your stop doesn't get hit, then of course you've not lost it. But if you can accept that before the trade gets there, then it means that there's no reason not to just leave your entry there and take that fill. Also then, once you're in the trade, look at, are there signs that give you more confidence in the trade? Is there something perhaps in the price action on that ladder that says to you, yes, this trade's definitely going to work now? Those little triggers, that's an opportunity to pyramid. That's where you can improve it to start making more money out of the trade. Build on the trade in that sense. So again, that can get built into your strategy. So look at that kind of element of once you're actually in the trade and what makes you feel confident. Next up, look at your stop. Again, first up, did you adhere to your stop? Are you moving your stop too wide or too narrow? And again, you've got to question why you're doing this. Is it a case that you're moving it too narrow because you're down on the day? Is that a consistent thing that your stop all of a sudden gets smaller if you're down on the day because you don't want to take such a big risk? Ultimately, it's meaning that you're getting stopped out more frequently, so actually all those small risks or all those small stops are actually worse than getting the one larger stop. Or are you doing the opposite, and as it goes offside, you've got a denial element and you're not stopping out of the trade because you don't want to take the loss? So you've got to look at both sides of it. Are there any characteristics in the build up to the trade that's changing that? And if so, you've got to address that side of it. And again, always look at it from an improvement point of view. And finally, target. Again, are you holding it to the target? Make sure make sure you're looking at that. And if you're not, what's stopping you? Are you taking some off a little bit earlier just to make sure you bank some money? Is it that as soon as you get a 1-for-1 risk reward with your stop that you're taking some off? So essentially you've got a scratch. By doing this, what happens is you're always limiting the amount that you take to the target, but you'll always still get stopped out on the full amount. So maintain that kind of thought process, that by getting out too early, you're actually taking quite a lot away from the trade. Also, consider how you feel when you do exit early. Is that feeling of, when you start doubting the trade, you get out a little bit early. If the trade then goes to target, how do you feel then? And you've got to then weigh up that feeling when you're in the trade that says get out. You've got to weigh that against the fact of missing out on that trade, and think about always looking at it to go to target. That's what you've planned, is what the trade shows you. So you've got to work out a way to sort of get around that and get your mind in the right place as you enter the trade to let it go. Always, as I've mentioned a couple of times, it is about finding ways to improve your trade. It's not about finding ways to discredit it or begin to doubt yourself. So always have that mindset that you're looking to improve the trade. You're looking for a way of making yourself better, a way of making trades more efficient at any time. Ongoing improvement in a trade is key. If you, every time you do the trade, evaluate it and try and find a way to improve it, it's going to help you adapt. The biggest difficulty in trading is always adaptation. Everything does need to adapt, and if you're not continually improving your trade, what will happen is all of a sudden it will stop working, and then you'll have to try and adapt it full scale. The whole trade will need readapting or a whole new strategy developing. If you're continually improving it, then this adaptation is ongoing anyway and doesn't need to take place on a big scale. So if your trade, you're finding it's not working, first up, you've got to be questioning, is it you or is it the trade? Is it the fact that perhaps you're getting out too early, you're stopping out too early? That could be one of the big factors in it. Or is it actually the trade, that the parameters are different, things have fully changed? So retest it, go back through the criteria, see if your recognition is getting the same thing, or are you very comfortable in the trade and you're just spotting it any time and taking it on, irrespective of the criteria. And this can also be a case when you're on a good run, that you start just looking at trades and going, yeah, that'll do, it's come back to the VWAP, and you don't actually think about all the criteria of the trade. So make sure it's not just you, but it could be the trade as well. If you're finding that the criteria for the change is differing, then it's a case of adjusting the parameters, move the entry, move the stops. If it still gives you a respectable risk reward, then the trade still can be done. Perhaps the market's got more volatile, and that could be why it's not working, because your stop just needs to be that little bit bigger. So that can be a way to improve it as well. That isn't necessarily just you, it's that recognition side of it. If it is you and you're finding that you're getting out too early, then it could be a case that what you do, put your order in, put your stop in and walk away. Literally walk away sometimes can be the easiest thing to do. Put your trade on and take a step out the office, go for a walk, come back and then reassess it once the trade's on. You're either going to be stopped or you're going to be still in the trade, and then wait. It'll give you a chance to clear your mind. You won't have all that adrenaline pumping as you put the trade on, and so perhaps that's a way to get over that. Ultimately, it's all down to you finding that way that you're going to overcome that difficult bit in your trade, if it's you that's causing it not to be working. If market conditions have changed that much and it's not working, you'll be able to see this particularly in the statistical performance, then just stop using the trade. It could come back and you still got the trade. You know what to do if it starts coming back and working again. So always keep these trades, keep trying to spot them, but if you're seeing they're not working, then quickly stop trading them, because it's just going to be detrimental. And as I mentioned at the beginning, it's an opportunity cost that you're doing trades that are actually costing you time and money, when you could be implementing much more viable, successful trades in other markets or in another way of doing it. Now, if the trade's working, this is where you've got to start thinking still about improvement. It's very easy to see a trade work, sit back and think to yourself, right, well, I've nailed this, I'm just going to keep clicking this trade. think about how you're going to improve it. Are you going to be able to increase the size? How are you going to go about this? And we'll be doing a bit more of that in the next day on that continual development, developing challenges for yourself. So think about increasing the size on it. With this type of trade, then it's quite easy in a way to increase the size because you know what the trade is and you know where the stop is. It's just an acceptance that you're going to take a bigger loss, but equally you're looking for a bigger win by increasing the size. Is it that the trade is working precisely and you've got to hold it to the target? If you're finding that you're taking a bit off beforehand, then again, give yourself that challenge. Hold the whole trade to target, or use that increase in size, add a few extra lots and make sure you hold those all the way to the target, even if you are taking a bit off earlier. Look for areas to pyramid. Again, that's going back to that evaluation of confidence. What tells you that the market, that the trade is on? Use that to pyramid. And again, make sure you do. And evaluate that. Is your pyramid working at the right time? Are you always getting the pyramid away, or are you waiting for those specific moments? Assess how well you're doing on that as well. And also look at how you can make it a continuation trade. Perhaps there's a way of trailing a stop on something and letting it go through the low and wait to see the move continue onwards. So always be looking at ways you can improve it. Write these down, get something that you're seeing or something that you want to improve, and then create yourself a challenge, create yourself a task to do so. As I say, we will be looking at this in a little bit more detail in the days to come. You're going to need to manage the risk on every trade. Now, some trades provide you with quite a clear risk management process, whereby the one that we've had an example has got a very defined stop. So every time you know that the risk will be the same. However, other trades like this euro dollar swing rebound trade gives you a different risk on each trade. However, the trade idea is still the same. So this is a swing rebound trade. The idea of the trade is you enter for a reversal with your stop below the swing high or low. So in trade one, because the candle has made a new low but then closed inside the previous candle, that's where your swing rebound trade comes in. You're looking to then enter at the close with your stop below the low. So in this case, you'd be entering at 06.49 with your stop below 06.44. So you've got 5 ticks plus whatever stop you're going to give it. So say another 5. So you've got basically a 10 tick stop. Trade 2, however, your entry is at 06.99 and your stop above 07.10. Again, if you give that an extra 5 ticks, then you're actually looking at a 16 tick loss there. So clearly a difference in size of loss of the trade. However, you can manage this. You can manage it by giving yourself essentially a monetary value to the amount you're willing to lose on any trade, and then adjusting your size accordingly. So, for example, a 10 tick loser on 3 lots is the same as a 6 tick loser on 5 lots. Look at it from that principle. And so that way you're always maintaining the same level of risk on every trade. However, a slightly more dynamic way of doing it, and I find this can work a lot better sometimes, is assigning almost a ranking of quality to your trade. Whilst the two trades are essentially the same trade, the trade 2 has got an extra element of quality to it because of the fact you can see that high volume node at the high, and that's pretty much where the trade stopped. So it's clearly marked out where there is a likely turn anyway. So there could have been a trade around selling it towards the 0710s, towards that high volume node. So this trade, in my opinion, is a slightly higher quality trade. Therefore, I might be willing to use the same size and accept the larger risk because I feel it is slightly more likely to pay off because of those extra factors that are added into the trade. It's not just a swing rebound trade on its own. So that's a slightly more dynamic way of managing risk. It is up to you how you do it. You could have a very consistent way, just always risk the same amount on every trade, and thereby you know that you've got so many trades within a day before you'll get to the limit of how much you're willing to risk on the day. Getting in early and getting out early, remember this, increases the risk of your whole trade. So the trade as a whole over time. If you're consistently getting out early, your risk reward is diminished. We saw that in the statistical analysis. So always remember that, always have that in the back of your mind. And also, as I've mentioned earlier, missing trades has a big opportunity cost as well. So keep that in your mind, play the trades to their potential, and make sure you actually get paid when you've taken the risk on. And finally, again, something else to remember in terms of risk. Even if you're down on the day, the trade is going to work out exactly the same. It doesn't matter whether you're up your best day ever, whether you're down a bit, whether you're down on your worst day ever. The trade will work out exactly the same. It's either going to stop you or give you a profit, irrelevant of how well you're doing on the day. And this can often be a big factor, particularly psychologically, that when you're down, you start doing that thing that I mentioned. You narrow your stops, you start taking your profit a little bit too early. So a trade that has a good potential in it, you end up either jumping out early or stopping yourself out because you don't want to lose any more money. If you keep stopping yourself out with small losers, essentially you are just going to grind your way to that stop anyway and give yourself no chance of making your money back if you're down. Equally, if you're up, you're basically capping your day. You might as well manage your risk in another way and just go home. Take the risk away, reset, come in the next day. So that's how I look to manage risk, either a slightly dynamic way or just manage it from an exact monetary perspective. Once you've got your trade defined, you know the entry, you know your exits, you know what you're going to be doing with it, put it into a playbook. Create this playbook of all the different trades that you consider doing. Understand the times when they're right to be used. And what this does is it just builds over time, and eventually you've got a huge playbook of different trades that you can be using, and you can go back to them. If they stop working, they're always still there to come back to in the future. So list them all and do simple things. Give them a name. It might sound silly naming your trades, but this way you're going to remember them if you need to come back to it. So call this the VWAP trade. Know the markets that you're going to use it in, the type of trade as well. So you know that on any particular day type, you can almost flick to a page in your playbook and know the types of trades you want to be looking for. Obviously, this is then going to include the criteria for the trade and the execution, which we've already been through. And also what I like to do, and this is part of my debrief that we'll be talking about in day 8, annotate the charts. Every time you take the trade on, annotate the chart on where you got in, where you got out of the trades. This way you're going to be able to look back and monitor your improvement. You'll see those successes. If you start changing things and find that every time you are then starting to get out above target or at the target, then it's going to give you a greater feeling of success. So get those annotated charts, get them in your playbook. You're always going to be able to have that, and then you'll be able to take it forward every time you see a new trade, and then also go back onto older trades. All right, guys, it's over to you now. Remember everything we've been through regarding ideas, testing, execution, evaluation, and improvement. Obviously, the execution and evaluation may not be doable immediately, of course. So this is more about testing that. Get those definitions down. Understand exactly what it takes to get these trades to work. I'm going to give you a few ideas to be researching, to be having a look at. Hopefully, this gives you a little bit of a starting point. So first up, look at those single print continuations in the DAX and oil. This is that trade that we talked about on the market profile day, where you have a trend day, reverses back to single prints, gives you an entry and then a continuation. So go back and test that as to what exactly is going to get you in and all your targets for that trade. Next up, have a look at swing rebounds. This is whereby the market makes a new high or low. The candle that makes the high or low closes back within the previous candle. That's your 15-minute swing rebound. The idea of the trade is to look back up towards the top of the range or the other side of the range. So have a look at that in the DAX and the Euro, but you can have a look at it in any market. Inside day breaks, this I would particularly recommend having a look at in the Bund, the actual breakout phase of it, but also as a little hint, have a look at VPOX. Another breakout trade, P-shaped days, what it takes to see one, and have a look at how you would execute that trade, where you would look for it to move to, and then what you're going to do afterwards. and also a 5-minute flag. Look for these in any markets. It's a continuation pattern. I would suggest, particularly when you've seen a higher volume type move, but look for those 5-minute flags. Have a look at how many of them actually work, where the trade would be on it. Is it on the close? Can you preempt the flag? So have a look at a few of those things. I'll give you a template to work with, and we'll leave you to that. Hopefully this will begin your playbook. If you want a bit more on playbooks, do have a look at Brannigan's course. He's got a very, very detailed course on volume profile that is very focused on playbook and how to develop strategies. Add them all in. You'll end up at the end of that course with quite a few strategies for yourself, all based around volume profile. So I'll leave you to it. Good luck.